Tilray Brands Inc. is currently trading at 9.38 USD, which represents an intraday increase of 0.25 USD or 2.74%. This movement is unfolding right now on Friday, January 9, 2026, as the market processes the massive wave of data that just hit the wires. While many traders were looking for a quick pump based on headlines, the real story is much more grounded in the balance sheet. For years, the expectation for Tilray was that it would simply track the general sentiment of the cannabis sector, rising and falling with every tweet from a politician. The reality we are seeing today is a company that has effectively decoupled itself from being just a weed play. It has transformed into a diversified consumer goods powerhouse with a massive footprint in the beverage and wellness space. And for the first time in a long time, the financials are starting to back up the ambition. Investors often approach Tilray with the same mindset they might use for Tesla stock or Nvidia stock, looking for that high volatility, high growth narrative. But the current action suggests a shift toward a more mature valuation model. Just yesterday, the company dropped its second quarter fiscal 2026 earnings, and the numbers were a wake-up call for the bears. We saw record net revenue of $218 million. This was not just a small beat. It exceeded what the street was expecting by a significant margin. More importantly, the company has finally moved into a net cash position. When you look at the landscape of companies you might find on a typical individual brokerage or a modern trading platform like SoFi Invest, very few in this specific sector can claim they are sitting on $292 million in cash and marketable securities while actually reducing their debt. This financial stability is why we are seeing such a strong reaction in the share price today. People expected another quarter of burning through capital, but the reality is that the management has tightened the screws on operations. The net loss improved by nearly 50% compared to the same period last year. This kind of fiscal discipline is exactly what institutional players look for when they're deciding whether to include a ticker in something like Schwab Intelligent Portfolios or various Fidelity ETFs. The days of Tilray being a meme stock are fading, replaced by a narrative of operational excellence. If you are using a Fidelity mobile app or checking your positions on the Robinhood stock app, you probably noticed that the stock has been showing a lot of strength lately. This is partly due to the recent 1-for-10 reverse stock split that took place back in December. While retail investors sometimes view splits with suspicion, the goal here was clear: get the price into a range where institutional wealth could actually participate. Many large funds cannot buy stocks that trade under $5, and by moving the price up, Tilray has opened the doors for the big players who manage Fidelity wealth management accounts and Interactive Brokers platform portfolios. Looking at the business itself, the diversification is the real anchor. While everyone focuses on the cannabis aspect, Tilray is now the fourth largest craft beer brewer in the United States. This isn't just a side project, it's a strategic move to build a distribution network that can handle both alcohol and, eventually, infused beverages. This makes the company a very different animal than its competitors like Canopy Growth or Aurora Cannabis. When you use online investing tools to compare these companies, the revenue mix at Tilray is much more resilient. They have their hands in medical distribution in Germany, craft beer in the US, and a dominant position in the Canadian retail market. The regulatory environment is also reaching a boiling point. The recent executive orders reclassifying cannabis as a Schedule III substance have changed the math for everyone. For a long time, the expectation was that federal legalization was a distant dream. The reality is that we are now looking at a massive corporate tax break for these companies because the 280E tax rule will no longer apply in the same way. This means that revenue that used to go straight to the government can now stay on the balance sheet. This is a massive catalyst that isn't fully priced in yet because the market is still skeptical about the timing of the rollout. Comment below how many shares of Tilray you currently hold, or if you are looking to start a position this week. I am curious to see if you think the beverage side of the business is more valuable than the cannabis side in the long run. When we talk about self-investing and picking individual stocks, it is important to look at the volume and the institutional activity. We are seeing a lot of high-volume buying on the Interactive Brokers trading platform today, which suggests that the smart money is starting to rotate back into the sector. This isn't just retail hype on the Robinhood stock trading forums. This is a fundamental shift. The company's regulatory medical business grew by 36% year over year. That is a massive growth rate that many tech stocks would be jealous of. Yet Tilray trades at a much more reasonable valuation relative to its sales. For those of you using Fidelity mutual funds or an intelligent portfolio, you might be wondering how this fits into a broader strategy. Tilray is increasingly looking like a value play hidden inside a growth sector. They have maintained the #1 position in the Canadian market while simultaneously expanding their wellness and hemp-derived products. Their Molo and XMG brands are already making waves in the non-alcoholic and THC beverage space, which is perfect for the dry January trends we see every year. This ability to capture different consumer segments is what gives them a safety net that other pure-play cannabis companies lack. If you are using investing help or exploring different investing sites, you will find that the sentiment around Tilray has been extremely polarized. On one hand, you have the arch skeptics who remember the bubble of years past. On the other, you have analysts who see the path to positive free cash flow becoming very clear. The reality is somewhere in the middle. The company is still facing margin pressures in certain segments, especially in beverages where they are still integrating recent acquisitions. But the overall trajectory is upward. They have reduced their total outstanding debt and are now in a position where they can be opportunistic with future acquisitions. The trading platform you use, whether it's the SoFi Active Investing or an Interactive Brokers account tools, can give you a good look at the technical levels here. We are seeing a lot of support around the $9 mark, which used to be a point of resistance. Now that we have broken through and are holding above it, the next major level to watch is the $10 psychological barrier. Breaking that would likely trigger a lot of algorithmic buying and perhaps a short squeeze, given the historical short interest in this ticker. The story of Tilray is a story of transition. It is moving from a speculative startup to a mature consumer packaged goods company. This is why it is becoming a more attractive option for people who manage their own Fidelity IRAs or use Robinhood investments for long-term growth. The management team, led by Irwin Simon, has been very vocal about their goal to reach $4 billion in revenue. While that is an ambitious target, the infrastructure they have built is capable of supporting it. They have the cultivation space, the manufacturing agility, and the global distribution channels to make it happen. When you compare Tilray to something like Apple stock, obviously the scale is different, but the principle of ecosystem building is similar. Tilray is building an ecosystem where a consumer might buy their hemp protein in the morning, a medical product in the afternoon, and a craft beer in the evening. This diversified approach is what will likely help them survive the volatility of the cannabis market, while other smaller players get washed out. It's a game of scale, and right now, Tilray has more scale than almost anyone else in the room. The macroeconomic pressures are still there, of course. Interest rates and consumer spending are always a factor. However, because Tilray has moved to a net cash position, they are much less vulnerable to high interest rates than they were 2 years ago. This is a huge advantage when you are trying to grow in a competitive market. It allows them to invest in marketing and new product development while their competitors are struggling to just keep the lights on. This kind of detail is often what you miss if you are only looking at the surface-level news on the Robinhood crypto and cash management tabs. As we look at the future outlook, there are a few key catalysts to keep an eye on. The implementation of the Schedule III reclassification is the big one, but the expansion of the German market is also a major driver. Germany has the potential to be a massive revenue generator as they move toward a more open adult use model. Tilray already has the licenses and the facilities in place to dominate that market. This international growth is often overlooked by investors who are only focused on federal U.S. policy. In the final analysis, today's price action is a reflection of a company that is finally getting its house in order. The expectation was that Tilray would continue to struggle with debt and losses, but the reality is a record-breaking quarter and a strengthened balance sheet. The contrast between what people thought would happen and what is actually happening is what creates these buying opportunities. Whether you are using SoFi Active Investing or a Fidelity brokerage account, the data is telling a very specific story. The fundamental setup for 2026 is stronger than it has ever been. To summarize the central insights we've covered, Tilray has successfully moved past its phase as a purely speculative asset. By diversifying into craft beer and wellness, they have created a stable foundation that can support their more volatile cannabis operations. The record revenue of $218 million and the move to a net cash position are the two most important takeaways from the recent earnings report. These figures directly challenge the narrative that the company is a permanent money loser. Furthermore, the 1-for-10 reverse stock split has cleared the way for institutional capital to enter the fray, which could provide a new level of support for the stock price. We've seen how the market's